Welcome, Wall Street Alpaca here. We are taking a look through the Tandy Leather Factory Form 10Q, referred to as the 10Q or the quarterly report. And that quarterly basis is talking about on a year time. So there's four of these reports a year from a public reporting company. Now, this is the most recent 10Q for Tandy, and it's all the way back in the first quarter of 2021. And their accounting year is the standard accounting year that ends on December 31st. So this is their company's numbers as of March 31st, 2021, as of the first quarter. And we're just going to do the superficial high-level view and this video. It might be even kind of a brief video, and then I think I'll take a closer look at each sheet, each of the financial statements here when once we've familiarized ourselves with what the 10Q is in general and the kind of information in the 10Q. So the 10Q is not nearly as jam-packed with information as the 10K, which is the annual report. Form 10K is the annual report. But we will find everything in the 10Q in the 10K. And so we might as well get piece by piece information here. Let's look at this. It has all the information about the company here as far as contact, headquarters. And here we go into the 10Q. So we start, it goes almost right into the financial statements, which is very different from the 10K annual report, which has the financial statements maybe 50 pages in. So the 10Q is just to keep you updated on the financials mostly. And in this case, we are looking at the consolidated balance sheets. That's right here. The headline is consolidated balance sheets. And this company, at a glance, has total assets of $76 million because these numbers are in thousands. It'll mention that, amounts in thousands. So 76,732 times 1,000, that's 76,732,000 in total assets. And here we'll go down and get the total liabilities. Let's see, we've got total current liabilities, and then we have long-term liabilities. And I'd like to see a total liabilities line item, but it does not exist here. Anyway, the current liabilities of 14.8, and then here's some change, and then 9.1. So that's about 23 million. So 76 million in assets minus about 23 million in liabilities. So that is what this number is here. Stockholders' equity is 51 million. So that's assets minus liabilities equals stockholders' equity. That's referred to as the accounting equation. And it's how this whole statement is built. Assets, get the assets in a number, get the liabilities in a number, compare them, and get the total stockholders' equity. So this company has a 51 million stockholders' equity. The assets are, let's see, you were looking for intangible assets here, so we could basically pretend they don't, just ignore them. But this company is not claiming really any intangible assets. These are all real assets. They have $10,761,000 cash in their bank, and cash equivalents like a very short-term treasury notes with the U.S. government. They have $10.7 million. They have 38 million that they've invested in inventory. So that's literally money that they have made and then bought inventory with. So if they had just quit what they were doing and didn't have inventory anymore, they would actually have 48 million. They'd have more than that. They'd have $49 million cash, just to get an idea like, is this company rich? It's like it's pretty rich because we're going to look through the assets, right? We got the two big assets that covered. The bank account is fat, the inventory has a lot of investment, and they have property, plant, and equipment of 27 million less depreciation. So that's money they've invested in stuff like their warehouse, and that's how the assets add up altogether. Now, this operating lease asset is not a real asset. That's accounting buffoonery that was created by the accounting regulation uh, entity that regulates GAAP, U.S. accounting standards, which are called Generally Accepted Accounting Principles. That's what GAAP means, GAAP. And maybe you've heard the term before. And the operating lease asset is not real. So the operating lease liability is also not quite real either. And it's 9 versus 11 here, so it washes out. Anyhow, we'll move to the total assets. So we get the 76 million. We know that 11 million of it is not real. So they got actually 65 million in assets. And they're all hard assets. This is important because that means when you buy a share in the business, you're buying a little piece. Okay, if you probably won't own 1% of the business, but any smaller and it's too hard to really talk about it. But you'll own a little bit of 1% of the business in all likelihood as an investor, right? You actually own that 1% of that 10 million 7. You actually own 1% of that 38 million 8. You actually own it. It's yours. In the case of the law is concerned. And that's how this whole thing works. So well is that you actually are the owner. It's not a crypto gambling game. You own this like you own a house without a mortgage. The only difference here is that you have ownership without necessarily having control, because control is based on all of the owners, a majority of the owner shares. So if people get together and they own 51% of the business, they can possibly steal it all from you. But that's just how life is, right? So deal with it. Don't invest in companies that are owned by 51% or more ownership of dickheads. It's pretty simple. So anyway, you do actually own this. That's what's so cool about this. Like, think about this. If you're a kid, if you're like a kid, if you're a young adult, if you're a grown person, but look, you buy shares in this business, you're actually buying cash. Like $2, you're buying $1 of cash for every dollar that you buy in as a share of the business at $5 right now per share. You're actually getting over $1 worth of cash that you own legit. And then with the inventory, you actually are getting you're getting the cash plus the inventory, and the whole business comes for free right now at today's price, because you can see the stockholders' equity, and this is a tangible equity here, like that, that's cash and inventory minus uh, 8 million in accounts payable. Okay, so that's stuff they're going to pay as part of business to the vendors. The long-term debt is 429,000. So it's peanuts at the numbers that we're talking about here. So that's how we see that stockholders' equity is literally real assets. So you're getting the business for free while you buy the company. It's a ridiculously low price, and it's lovely opportunity for us. I think you should stop watching the video and go buy this stock. That's what I would do. I can't give you that advice. That's not advice. But what I would do if I was watching this video from Wall Street Alpaca, I would definitely just say, oh, fuck, I'm just going to stop watching the video right now to make sure that I buy the stock right now. Because you're getting a business for free here. And what does this business do in the first quarter? So let's move down to the income statement. This is actually they're calling it the consolidated statements of operations and comprehensive income these days, but this is called the income statement. And in the first quarter of 2021, okay, so remember, you buy the business, for free, you just pay for the assets here. Net sales of $21 million with a gross profit of 12 million on that sales. Okay, so let's think about that. Could we possibly squeeze some profit out of 12 million gross profit cash that's coming in when all we own are 100 stores? So I'd say yes. Yes, we could squeeze a nice gross profit, a nice profit out of that. Now, let's see what they actually did though. They got operating expenses that were pretty high then, 11,221,000. So their income for the first quarter was 965,000. So that's a profit of 965,000, everything said and done. And then taxes. So it's a profit of 745,000. That's that net income line. That's the after-tax number. 745,000 in business earnings in the first quarter. And here we talk about the earnings per share number is simply $745,000 in this case, the net income divided by the number of shares outstanding. And here's the number of shares outstanding they used for that calculation. 881,000 or 8,811,000. 8,800,011,752 shares. Okay, but we actually know that the shares are lower than that. We'll see that number later. The shares outstanding are lower than this, but this is simply an average of the shares over the 3-month period. And in the middle of those 3 months, they bought back stock. So it's actually now 8,666,000 shares. Okay, so the income statement is telling us though, so what's this told us altogether? After the net income line is what we need to know about, right? And foreign currency maybe it can be important, but here it's small. 745,000 after tax in the first quarter. So if they just repeat that for 4 quarters, we buy a business for the price of the bank account and the assets. And then it starts making $745,000 for us every 3 months. It's 12 months in a year. So what's the annual income on that? Just shy of $3 million after tax income. All right. We are looking for more than that, but we do know some stuff about this business. Like these operating expenses are high because, and they're going to be lower in the future because this operating expense includes restatement expenses, which were probably $500,000 for this quarter. And so that would add after tax, that would add another 250, 300,000 to the net income line here. So this actually made $1 million in the first quarter, or you can expect it to next quarter, right? Okay. There's also some things about this that you need to think about. Like, what does any smart business owner do? Any smart business owner creates as many expenses as they can in where they don't actually have to pay anything, but they can create an expense for the tax man. So the tax bill goes down because every expense you have in a business, you can write off. Every legitimate business expense you can write off. So we'll come back around to this just in a second because we're going to be moving from this net income statement here, and we're going to be looking at the cash flow statement. So remember though, it says for the first 3 quarters of operations, 745,000 net income after tax. That expense for the restatement is going to drop off. So we know this is already lower than its real earnings power going forward. And let's move on to the next statement. We have the cash flow statements. This is the statement of cash flow. And here it's also for the first 3 quarters of the year, same time period we're looking at. And check this out. This net cash provided by operating activities was $2.2 million. And that definitely takes in, and that is, another, 500 grand went to my estimate, 500 grand went to the restatement expense. So this is more like after tax, add that back in, but we'll say 2.5 million cash in the first quarter. And that means, should we use this cash flow statement number of 2.2 million to say what's going to be our return? How much is our business going to kind of make for us in the first quarter? Or should we use the net income number as this is what the business is expected to earn in, a first quarter? Well, it's a bit of a balance between the two because remember we want to bring this number down as much as possible because this is the number that we get taxed on. Up here we get taxed on this, and then that's the number after the tax, the net income. We don't want that to be a high number ideally if we're getting rich. Anyway, who cares if that number looks low? In this case, it's much more attractive to value the company based on the cash because that is cash that we can use. We could use that cash. It's not like the cash isn't ours. It's just like having that income in that way as business owners. So I'm much more leaning toward using the 2,000,002 cash flows number. And that is going to be important in just a minute because if you multiply the net income of 750, call it the $1 million, the $1 million net income on a quarter times 4 for the year, that's only 4 million. But 2.2 million times 4, that's 8.8 million income. So that sounds better to me. Doesn't it sound better to you? Make more than twice as much money. Now here's cash flows from investing activities. So this is where some expenses end up popping up. Purchase of property and equipment. That's the main line in this case. Now, since this company is more, it doesn't operate a factory. That's a good thing because they don't have to invest capital back into the business as much as a factory or manufacturer does. Yes, I know Tandy Leather Factory has factory in the name, but they are not operating any factories. Okay, but they do have really good quality control and all that. They basically have other people operate the factories for them, so it doesn't show up on their income statements. And that's good for us because that 2.2 million doesn't have really a big minus here. So that's a solid 2.2 million that's coming into the business. Now in the financing, this is where things like repurchase of capital stock, or if they pay down debt, or if they make debt, they list that here. In this case, also dividends, but there's no dividends in this case. But in this case, it is repurchase of common stock. So the repurchase of the common stock, that's a buyback. That's called the stock buyback. And this means they spent, the parentheses mean that money went out from their bank accounts. They spent 1.6 million buying back their own stock while it's cheap. That's the thing that we want to see a company do. If they could buy back twice as much as that in the first quarter, that would be good. But they couldn't. They could only get their hands on that many shares, and no one would sell them any more shares than what they bought there at that time, because most investors recognize that it's a really cheap company and the stock's going to go up, and they don't necessarily, and if they don't need the money right away, no one's selling the stock back to these guys right now. That's just how it is. And here it mentions the cash in the bank account that we saw in the balance sheet, 10.7 million cash in the bank. Here, the 10Q next talks about the consolidated statements of stockholders' equity, right? So it talks about the capital structure a little bit, and this is a very simple capital structure. There's just share, it's just a business. They split it into shares, and there are 8.666 million shares outstanding now. After that buyback that they performed, you can see that here, the repurchase of common stock. That means they took 500,000 shares away from the world, gobbled them up into their own company, and now each of us own a bigger percent of the company. So if you own one share out of 9,150,000, or you own one share out of 8,666,000, which puts you into a better position? In which case do you have a bigger slice of the pie? Obviously, when you own a share in a smaller pie. So that's what the company has done for us investors lately. Now here, there's some notes. They're going to talk about relevant history. They're going to talk about what their company is briefly. They have 106 retail stores, 95 stores in the US. Okay, they're going to talk about how COVID, because that's just a topic that everybody has to talk about this year. And some notes, detailed accounting notes for people. Here we can see, this can be important because they disaggregated the revenue here. And in this case, they tell us, well, where did we make the money at? And this matters because, so in this case, it's just perfect for us. They make almost all of their sales in the United States, and that means they're making all their money in US dollars, so there's no complication. But some companies, they might sell more overseas than they do here, and they sell in Indian rupee or something, or they sell in euros, and that can be that's called a currency risk. It's a risk of its own, but we don't have to deal with it. We don't have a currency risk here. A little bit of 10% of sales were made in Canada. So there's a little bit of currency risk, but Canada's right there next to America, and they have a pretty reasonably stable exchange rate with what's called the Canadian loonie, or the Canadian dollar. So that's good. I like simple. This is nice and simple. This is Tandy Leather Factory as a company. It's a pretty simple company, and that's what we're seeing in the statement. Here they just give some details. This is the 10Q, some accounting details. They talk about basically a lot of this is copy pasted from accounting regulations, where they just have to tell you what they're doing. Here, so look, only 500,000 of their assets are trademarks or copyrights on their balance sheet. So that's what I'm saying. You're getting all this. You're getting $1 for every dollar you buy worth of shares in Tandy. You're getting like 80 cents of inventory and 20 cents of actual cash, and there's really no debt on the business. So that's really good. You get the business for free when you buy this stock right now. It's just an amazing opportunity at a low price. And I'm not going to be able to talk about this business, so I'm just going to scroll through the rest unless something really interesting pops up. I'm not going to be able to talk about this business in this way in the future, but I like the business in a bigger way than just because it's a bargain price. It's just that right now I want to emphasize to you, if you find this video right now, I mean it's October 2021. If you find this video right now at this price and this stock is trading at this price, I'm just trying to do people a favor. I mean, that's what I'm trying to do. I don't think, like, is it going to save my soul if I help you make money? My soul kind of feels that way. I think that would help me. So you can help save my soul, you know, if you can't figure out a reason to buy the stock on your own, you're shit out of luck. But as far as I'm concerned, it'll help save my life if you buy the stock and make yourself richer. I guess I'm just a saint in that way. And that's why I'm making this video. That's why I invented Wall Street Alpaca, and so on and so forth. So here they talk about, this is relevant. They talk about the share repurchase program and an actual share repurchase. So we're looking at them right here. August 9, 2020, right? Board of Directors approved repurchase plan. Okay. So what they did is they approved a $5 million repurchase, and that means that at management's discretion, they can pull the trigger and buy back another $5 million worth of their stock and shrink the shares outstanding even more. So each of us who don't have to sell, okay, they'll buy back the stock from people who are willing to sell it at the price. But we know we want to hold on because when they buy back that stock from the other people, we're the size of the pie, we're getting a bigger slice of the pie then if we just hold on to our shares because that's what happens when the total shares outstanding shrinks. The pie doesn't really shrink, but each slice of the pie becomes bigger, a bigger part of the pie, and each of our share becomes a bigger part of the total shares outstanding. So they've got this big 5 million authorization on the books. That's good. Hopefully they pull the trigger as soon as possible because the stock is real cheap. On January 28, 2021, we entered into an agreement. Okay, so here they talk about the repurchase of 500,000 shares that they have made. These were 500,000 shares that this institutional shareholder was willing to sell at what was frankly a really cheap price. But I mean, whatever. That's, I mean, that's good for us. So they bought back all that stock at a great price of $3.35 per share. So that's good. Here they mentioned they canceled the shares. So they're not like going to put the shares back out into the world. They just extinguished the shares with cancellation. And we just got another note from management. This is nice stuff, but we're not gonna do this in the video. You want to enjoy reading this for your own. If it pumps you up, that's cool. And this is more commentary. Here they talk about some stuff that what could I say? So most of this is very standard stuff, and basically it checks out. They're not, yeah, it checks out basically. So this is all standard copy pasted stuff from the regulatory body for accounting. And here they reiterate the results of operations. This 965,000, that's the income loss from operations. Oops. So that's that before tax number. The net income number, that's 745. That's after the taxes hit this 965 number. Let's see what else we have. Yeah, I think this is just a scroller. Just scroll, scroll, scroll. It's a rehash of a lot of the information with more details in the commentary. So this is the quarterly report. That's it. You got it. And the video already feels long, so it's not as brief as you might have thought I was going to make the video when I said it's going to be brief. But I hope you got some information out of it. The key points are this net income is going to improve as long as, you know, okay, so if the business stays steady, which looks like it'll stay steady, the net income is going to improve simply because they don't have the extra cost of the restatement. And so that's a good thing. And we looked at how the cash that comes in from operations can be at least as important as the income, what the accounting income. And we kind of justified, like, you know, a business wants to make expenses as much as it can to keep net income low, or lower the net income to lower the tax bill. But you can still see what happens on the net cash provided by operating expenses. So they actually brought in 2.2 million into their coffer and added that to the treasury. So we saw how to read the financial statement of income and the financial statement of cash flows. And of course, the financial statement of the balance sheets. which, has that remarkable number that we talked about. They've got about 50 million in real tangible knock on wood assets, and the whole business only costs $43 million right now at $5 a share. So you're even buying their inventory and their bank account for 90 cents on the dollar, and they're earning a good return, and then you're getting the business for free. So, boy, if this doesn't convince you, you're just beyond help, my friend. So, I can't spend a lot of time with people who are beyond help. Anyway, I hope you got the value out of the video, and good luck.